The dollar doesn't collapse. It times out. Here's the paradox. The system looks stable precisely when it's most fragile. Markets are calm, screens are green, headlines say resilient, but the math underneath says something very different. You don't experience this as an abstract theory. You experience it in rent, groceries, insurance, and the quiet shrinking of what your money can actually do for you. This system runs through your paycheck, your savings, your future. There is no outside. Every global reserve currency in modern history followed the same arc: rise, dominance, debt, decline. None escaped it, not because of bad leaders, not because of accidents, because the structure itself flips from production to dependency. And once that flip happens, reversal doesn't look dramatic. It looks normal. Here's the part nobody explains clearly. Collapse doesn't announce itself. It hides behind confidence and habit. By the time people panic, the damage is already locked in. And right now, one quiet number suggests the system has crossed that line. What's happening now isn't a single event, it's a pattern revealing itself. The core issue being discussed in this material isn't a crash, a panic, or a sudden shock. It's a transition, a long one. And most people miss it because they're trained to look for explosions, not slow structural failure. The system didn't break yesterday. It has been bending for years. The dollar became the center of the global system in 1944. That role gave the United States enormous advantages. It could borrow endlessly. It could consume more than it produced. It could pay real goods with paper promises. For decades, that worked. Growth covered the cost. Confidence filled the gaps. But here's where the framing matters. This wasn't free money. It was deferred pressure. Every reserve currency faces the same dilemma once it becomes too dominant. To supply the world with liquidity, it must run permanent deficits. That's not policy failure, that's structural necessity. Now notice the shift. Production moves elsewhere. Debt fills the gap. The economy still looks active, but its engine has changed. And once an economy crosses that threshold, the story stops being about choices and starts being about constraints. So ask yourself this: if the system requires confidence to function, what happens when confidence quietly erodes before anyone admits it's gone? The strongest claim here is simple, and it's uncomfortable. The system didn't drift into debt by mistake. It requires debt to survive. After 1971, when the gold link was severed, the dollar stopped being constrained by anything physical. From that moment on, the system depended on one condition above all else: that the rest of the world would keep accepting dollars and buying US debt. And for decades they did. Not out of generosity, but because there was no alternative. Here's the concrete detail that matters. To supply global liquidity, the United States had to run permanent trade deficits. It had to import more than it exported. That's not a temporary imbalance. That's the Triffin dilemma in action. The very role that gives a reserve currency its power also guarantees its long-term weakness. Now notice the language used when this pressure becomes visible. When inflation surged after 2020, officials insisted it was transitory. That word did a lot of work. It reassured markets, it calmed households, it implied control. But prices didn't reverse, purchasing power didn't return. The system moved forward as if the explanation mattered more than the outcome. Here's the detail most people miss. If inflation were truly temporary, it wouldn't require trillions in new money creation to stabilize the system. And yet that's exactly what happened. So the question isn't whether the system is strained. It's why the reassurance mattered more than the reality. Now watch how this escalates. Once a reserve currency can no longer rely on production, it leans on something else. Enforcement. Not in speeches, but in structure. Historically, this is the point where economic power quietly hands off to geopolitical pressure. Trade becomes leverage, currency becomes a weapon, compliance replaces trust. This isn't new. You've seen it before, just not framed this way. Late-stage empires don't collapse when they're weak. They collapse when they normalize behaviors that would have been unthinkable during their rise. Constant intervention, endless deficits, emergency measures that never end. Here's where the story flips. Instead of fixing the imbalance, the system doubles down. More debt is issued to cover old debt. More money is created to stabilize markets that depend on money creation. Each step is justified as temporary. Each step becomes permanent. And slowly the definition of normal shifts. Trillion-dollar deficits stop sounding extreme. Balance sheets that would have triggered panic a generation ago become background noise. The system survives not because it's healthy, but because everyone is locked inside it. This is the dangerous part. When abnormal conditions feel ordinary, warnings stop working. By the time the stress shows up in ways people can't ignore, the options are already gone. And that's exactly where the next piece of evidence becomes impossible to dismiss. Here's the contradiction that changes how you see everything. Publicly, the message is restraint, stability, control. Privately, the actions say something else entirely. Debt levels climb past historic thresholds. Interest costs begin to rival core government spending. And instead of slowing the machine, the response is to accelerate it. More issuance, more intervention, more reassurance. The disturbing evidence isn't just the scale. It's the mismatch between words and behavior. Officials speak about fighting inflation while relying on mechanisms that require continued money creation to prevent collapse. They talk about normalization while operating emergency tools years after the emergency supposedly ended. Notice what they don't deny. They don't deny the debt. They don't deny the deficits. They don't deny the dependence on constant refinancing. What they offer instead is confidence, forward guidance, narratives meant to manage perception rather than mechanics. Here's the line that permanently reframes the issue. A system that can't tolerate even small tightening without stress isn't stable. It's sensitive, and sensitivity at scale isn't resilience. It's fragility disguised as strength. Once you see that, the question stops being "can this continue?" and becomes "what breaks first when it can't?" This is where the pressure stacks all at once. First, debt servicing accelerates. As rates rise, the cost of maintaining the system climbs faster than growth can cover. Second, market stability becomes dependent on constant reassurance. Any hint of withdrawal triggers volatility. Third, policy options narrow. Cutting spending risks recession. Raising taxes risks backlash. Tightening money risks breaking something that can't be easily repaired. None of these developments happen in isolation. They compound fast. The system moves from managing outcomes to managing reactions. Decisions are no longer about improvement. They're about preventing loss of control. And the pace matters. These shifts aren't unfolding over generations. They're compressing into shorter cycles, weeks instead of years, announcements instead of reforms. Each response buys time, but at a higher cost than the last. Here's the unsettling part. When systems enter this phase, they don't fail because of one shock. They fail because too many small shocks arrive faster than confidence can absorb them. So the real question becomes unavoidable. Now bring it back to where this actually lands, on you. When systems strain, ordinary life absorbs the shock first, not through headlines, but through friction. Prices move faster than wages. Savings lose weight without ever being spent. Plans that once felt responsible start feeling fragile. You notice it when essentials creep up quietly and adjustments become permanent. Fewer options, smaller margins, less room for error. This isn't ideology, it's experience. Inflation doesn't announce itself as a crisis. It shows up as trade-offs, delayed purchases, side jobs, quiet anxiety about the future that never quite turns off. The system may call this stability, but for households it feels like constant adaptation. And here's the part that matters most. Once people are forced into survival mode, long-term thinking disappears. Trust erodes, social cohesion thins, everyone feels pressure, but no one feels responsible. That's how economic strain becomes social strain without a single dramatic trigger. If this feels familiar, say so in the comments, because recognition is usually the first signal that something structural, not personal, is happening. And once that realization spreads, the problem stops being individual behavior and starts being the system that produced it. To understand why this keeps happening, you have to stop looking at personalities and start looking at incentives. Systems don't drift, they follow pressure. When a currency sits at the center of global trade, it gains leverage. That leverage becomes habit. Over time, the system learns it can shift costs outward. Inflation doesn't stay local. Debt doesn't stay domestic. The consequences are distributed across borders, delayed and diffused. This creates a dangerous feedback loop. As long as others absorb the pressure, there's no internal urgency to change. The spectacle stays calm. Markets stay liquid. Political costs stay manageable. The system rewards continuation, not correction. Here's the unsettling insight. The system isn't designed to protect purchasing power. It's designed to preserve control. Stability becomes secondary to influence. Optics matter more than mechanics, and when that happens, the appearance of order replaces actual balance. This is why reform never arrives early. It only arrives after leverage fails. Until then, every signal points toward maintaining the center at all costs, even if the foundation erodes. That's not incompetence, it's alignment. And once you see that alignment clearly, the next phase becomes easier to anticipate. From here, the path splits, but neither direction restores the old normal. One possibility is slow adjustment. The system stretches the timeline, debt is rolled, new instruments are introduced, pressure is managed rather than resolved. From the outside, this looks like control. Volatility comes and goes. Markets adapt. People adjust expectations downward without ever being told to. The shift happens quietly through acceptance rather than shock. The other path is faster. Confidence breaks somewhere specific. Not everywhere at once. One market, one funding channel, one assumption that stops holding. When that happens, responses aren't gradual. They're immediate. Emergency measures return, rules bend, capital moves quickly, and trust doesn't wait for explanations. What matters is that both paths share the same direction. More intervention, less flexibility, narrower margins for error. The system doesn't regain balance. It trades time for complexity. And here's the key detail. You don't get to choose which path unfolds. You only get to recognize which one you're already on. Because the next move isn't a surprise anymore, it's forming in plain sight. Here's the insight that ties all of this together. What looks like economic instability is actually a confidence problem moving through a system built entirely on belief. Money works because people agree it works. Debt works because people assume it will be honored. Power works because enough people accept its rules. When those assumptions weaken, nothing snaps at once. It just stops responding the way it used to. This story isn't about a crash date or a single villain. It's about a structure that reached its limits and chose delay over repair. That choice buys time, but it also reshapes reality for everyone inside it. The mistake is waiting for a headline that says, "This is the moment." That headline never comes. What comes instead is a new normal that feels tighter, faster, and less forgiving than the last. Once you understand that, you start watching different signals, and those signals don't end here. If you want to stay ahead of what's forming next, follow for continued analysis. The next layer of this story is already unfolding.